Hey, any second now, we're going to get the breaking news that, nobody could have suspected. The breaking news that there's going to be a 25 basis point cut. And also, today is the most important Fed meeting ever since the last one, and until the next one, coming up in about 45 days. I'm Cairo Copeland. This is Reinvent Ideal, and you are watching Shut the FUD Up. Welcome, everyone, to today's stream of live coverage of the Federal Reserve meeting that is going to conclude any second now. And then in about 30 minutes, we will hear from good old Jerome Powell, where he says the absolutely dreaded, good afternoon. Tam Tam is here. Hello to my number one cheerleader. I see a lot of you are watching on X and elsewhere. Thank you all for doing so. So, yep, today is a very important day for deciding the rest of the market and the direction of where it's going to go probably for the rest of this year and then also for next year. I really stressed it last night in the spaces. If you were in the spaces, you heard me stressing like just how important that this Fed meeting is. Not so much like, do they cut rates or not? They're going to cut the rates. But what's really important is, what's Powell's tone going to be like? Is he going to be dovish or is he going to be hawkish? Everything really hinges on that. And this is why, I'll come back to this chart here a little bit later, but this is not what we want to see. Fed net liquidity is currently in a downtrend. Not good for us. If this does not reverse, we're in serious trouble. Serious trouble. And I hope that everybody kind of understands and appreciates the seriousness in my voice here. Like, even though I'm like the most optimistic, bullish person in our space, this is something that I do not want to see. Neither should you. We'll come back to that, though. Let's start with the real important stuff here. First, did the rate decision come out? Yes. Fed cuts rates for the second time this year. Will end balance sheet runoff in December. All right, there's some good news. Quantitative tightening will be stopped effectively in December. We were really hoping it'd be stopped today, but they made the announcement that they're going to stop quantitative tightening now. I think that's pretty good news. We'll come back to the story here. Let's see how the market is reacting to it. Not so great for Bitcoin right now at $111,747. That is still negative for the month. Surprisingly, Ethereum hasn't fallen below 4,000, although it's just $3 away from doing that. And it can easily fall below 4,000 because Ethereum is such a piece of garbage ran by a bunch of idiots at the Ethereum Foundation who all need to be thrown into a class action lawsuit by all of the Ethereum holders. If you don't know, I have officially gone super hatred mode on the Ethereum Foundation and Vitalik. He actually is the worst founder in this space. Everybody want to hate on Richard. Everybody want to hate on all these other people. I mean, the only person I can think of that's worse than Vitalik is probably Gavin Wood. But the level of neglect and the level of like pure disrespect that the Ethereum Foundation has shown for the Ethereum holders, it borders on an abusive spouse relationship. Nothing good to say about Vitalik. Nothing good to say about the Ethereum Foundation. Most of the other coins are really just kind of hanging in where they were yesterday and the day before. But here's the real standout. Keep pointing this out here. This World Liberty Finance and also Trump token. These guys are doing very well. I mean, look at Trump up 18% just on the day. What's going on there? And I say watch these guys, because a lot of insiders in the Trump camp could be the ones trading this, and they're the ones that are pushing that price up. So what do they know about today's press conference that we don't know? What's going on there? That'll be an interesting thing to see play out here for us today. As far as everything else goes, nothing's really looking really great compared to those two coins. Like, those are the ones that are really up the most here in my watch list. How about the RH ecosystem? Not great. We're back to red here. We were looking okay just a few days ago, but now we're back to red. But hey, we weren't expecting anything good until after the press conference. And honestly, I don't know if I'm expecting anything good. It all depends on how Jerome Powell speaks. His tone matters more than any decision. The decision is not what matters. It's his tone during the press conference that matters the most. So we got to really be on the edge of our seats, going through a whole pack of cigarettes before the press conference is over, probably. And I'll tell you why. Why is this so important here? Armando, I see that you're in the chat. Thank you for joining us today. All right, so let's refresh CNBS. And what's the story say here? We already had this story up. Let me just refresh it, see if they updated it any. All right, Fed cuts rates for the second time this year and will end balance sheet runoff in December. That means no quantitative tightening in December. That's good news. Federal Reserve on Wednesday approved its second straight interest rate cut, a widely expected move that came despite little recent visibility on the economy due to the government shutdown. Nobody cares. In addition to the rate move, the Fed announced that it would be ending the reduction of its asset purchases, a process known as quantitative tightening, on December 1st. By a 10-2 vote, the central bank's Federal Open Market Committee lowered its benchmark overnight rate to a range of 3.75 to 4%. Okay, let's check on something here. What's the bond market saying about this here? Where is that 10-year Treasury? Got to check that out here. Oh my, 10-year Treasury is right at 4%. What's going on there? That means that the two yields, the 10-year Treasury yield and the federal funds rate, are now right in line with each other. It's possible that on some days, like the lower bound of the federal funds rate will be lower than the 10-year Treasury, which is good. We want that to happen. That brings the world back to normal. Not quite happened yet, but it looks like we're getting there. Governor Stephen Miron again cast a dissenting vote, preferring the Fed to move more quickly with a half-point cut. Fed President Jeffrey Schmidt joined Miron in dissenting, but for the opposite reason. He preferred the Fed not cut at all. Okay, well, screw you, Jeffrey. These cuts, by the way, is not as the cut itself is not what's important here, because we'll talk about this later here. But when it comes to the interest rates, that just refers to the cost of capital, the cost of money. That doesn't really help so much with the creation of money, or what we call money printing. That's where you need quantitative easing, or the SOMA, to come in and do that. So even though this is good that they're cutting the rates instead of raising them, because it'd be bad if they were raising the rates, even though it's good that they're doing this, this is not quite going to be the most positive thing for your holdings here. All right, so I guess that means that Jeffrey was the only one who didn't think there should be a cut, so everybody else on the board believed that a cut was appropriate, so 10-1, that's good. Now, other than the consumer price index released last week, the government has suspended all data collection, blah, blah, blah. You guys weren't looking at that data anyway. In the post-meeting statement, the committee acknowledged the uncertainty accompanying the lack of data. You guys weren't using the data anyway. It's pointless. Each of those characterizations represented tweaks from the September statement. Statement reiterated concerns that policymakers have over the labor market, blah, blah. Fed tries to strike a balance between full employment and stable prices. The program, here's the important part. The program, also known as quantitative tightening, had shaved some $2.3 trillion off of the Fed's portfolio of treasuries and mortgage-backed securities. Instead of reinvesting maturing proceeds from the securities, the Fed has been allowing them to roll off the balance sheet at a limited level each month. However, recent signs of some tightening in short-term lending markets have raised concern that the roll-off has gone too far. They're talking about the reverse repo overnight facility. We'll get into that later. An implementation note accompanying the decision indicated that the Fed will be rolling proceeds from maturing securities into shorter-term bills. Okay, good. Thus reducing the duration of its broader portfolio. Previously, the Fed had rolled the proceeds over into securities of the same maturities. All right, so that's going to be an interesting. I know he's going to get asked about that. I'm going to hear what he's going to have to say about it. Markets recently have begun anticipating that the Fed would end QT either in October or by the end of the year. The Fed expanded its holdings during the COVID crisis, pushing the balance sheet from $4 trillion to $9 trillion. Powell has said that while the Fed found it necessary to shrink its holdings, he did not foresee a return to pre-pandemic levels. Okay, good. Evercore ISI analyst Krishna Guha said he could foresee a scenario where the Fed actually restarts the purchases early in 2026 for organic growth purposes as market conditions shift. Woo! That's something that we want to hear. They're talking about turning on the money printer again. The Fed rarely eases monetary policy during economic expansions in bull markets and stocks. Major averages, though volatile, have been posting a series of record highs, boosted by further gains in big tech stocks and robust earnings season. Okay, so why does the Evercore guy think that they would turn the money printer back on then? History has shown that the market continues to rise when the Fed does cut under such circumstances. However, easier policy also poses the risk of higher inflation, a condition that forced the Fed into a series of aggressive rate cuts. I think I mean rate hikes there. Rate hikes is what they meant there. All right, now we got to check something else out here. What's going to be very volatile during the speech today, during the press conference, is going to be the DXY. So let's see, we got to find that here. Let's pull that up. Where is the dollar index at? All right, going up here apparently. Yep, going up, but it will be moving around during the speech. We'll keep an eye on that. What changed in the new Fed statement? All right. Available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year. It does seem strange that they would be getting more. I was reading this statement and how it's not really bearish on the markets or anything, or bearish on the economy. Seems strange that they would be moving into easing. So there's no reason why they do this here. In considering additional adjustments to the target rate for the federal funds rates, the committee will carefully assess incoming data. Blah, blah, blah. Oh yeah, data dependent. Expect to hear that in the speech today, along with good afternoon. Yep. In assessing the appropriate stance of monetary policy, the committee will continue to seek the implications. Blah, blah, blah. Don't care. Okay, so really nothing too important to change. Well, wait, here's the important thing. The committee decided to conclude the reduction of its securities holdings on December 1st. So that's the end of quantitative tightening. The committee is strongly committed to supporting maximum employment. Blah, 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 blah. All right. Okay, so there's some good news there. We do like that working for us. We do like that they're going to reduce the balance, or they're going to stop the reduction of the balance sheet. All right. Now let's see. We've got the press conference open in our tab, which will be starting in about 15 minutes. Anything else here that we'll get into the rest of the stories here on CNBS. Still, that 10-year Treasury is going up, which I think is also probably why the DXY is going up as well. So we'll revisit this here in a little bit, probably after the conference. We'll just take a look at it throughout the conference here. But a little housekeeping here before we get into it. If you want to, if you want to have a free copy of this book, it's called "Your Parents Were Wrong." And no, it doesn't really cost $44.28. It should cost that much here. It does not cost $436 either. It's just showing that because I have a VPN. But here's the deal. If you want a free copy of this book, I will give you a free copy of this book. All you got to do is head on over to reinvent ideal.substack.com. That's reinvent ideal.substack.com. And just click right here in the middle where it says free gift. And then when you sign up for my Substack, where it costs you absolutely nothing, no cost to you at all to sign up for my Substack, you will get a free copy of that book sent to you by email. All right. So let's see what's happening in the chat here. All right. Hex.com army is here. Looks like we got somebody new. Manatalk Sesh. Welcome, Manatalk Sesh. All right. Now, a little preview of what the press conference is going to be like. I've got that right here for everyone. Where is it? Is it over here? Yeah. There we go.
Good afternoon.
Exactly how it happens, right? All right. Now, still waiting for, see, we got about 13 minutes before the press conference begins here. Now, here's why I stress just how important this thing is. Absolutely crucial that we hear a dovish tone today. And this is why. Is because if we look at Fed net liquidity over here, it's on a downtrend. Now, whenever it goes on a downtrend, and a particularly sharp one like this is here, I mean, we go from we go from was it 6 trillion down to 5.6 trillion. That's very concerning because a couple of times when they have a giant reduction in liquidity like that, like this was December 2021, where we went from 7 trillion all the way down to 6.5. That was kind of the end of like official alt season, or the Ethereum season at least, because I don't think Ethereum ever posted a new high after 2021 ended. We did, however, get a little bit more time to make money in alts all the way up until March because some liquidity was added again. But then, come April, we went from 6.7 trillion, sharp fall all the way down to 6 trillion, and man, it just kept on falling. Down to 5.9, down to 5.7, all throughout the year, it just kept falling. Finally closed in December at 5.5. So we're pretty close actually to like where we were in terms of Fed net liquidity at the bottom of the bear market. Or actually, we are right close to where we were here. We're lower now in terms of Fed net liquidity than we were at the bottom of the bear market November 2022. This is not good. We don't want to see a sharp decline in net liquidity like this. Let's see, reset the zoom here. Get it. We want to look at it like from here. Now, still, this is not a dramatic. It's not too dramatic yet. We look at this as pretty steady. It's not like the Gensler candle that we saw over in Hex and Pulse Chain. It's not the Interpol candles either. So it's not like that. But if this trend does not reverse, then we got real trouble, guys. And here's the kind of trouble I'm talking about. Number one, the rest of this year will really, really, really suck for crypto. I mean, I already said about Q4 is going to be bad, but it'll be worse than even I thought. And then most of next year will likely suck as well if this trend does not reverse. Because what is this doing? This is confirming what the 4-year fundamentalists believe all the time. What they've said all along. I mean, the 4-year fundamentalists will actually be proven right if this trend continues. Because you see, what I am posing, what I'm saying is the truth about all this. What's causing crypto to do what it does is liquidity. Net liquidity. It's all based on how much money is printed, how much credit is created, what is the total net liquidity in the world economy. That's what causes crypto to go up. This is telling you here that it's going down, and it will bring all of crypto down with it if the trend doesn't reverse. It just so happens that it's 4 years later from the previous high, almost 4 years later. It's a little shorter than that, but it just so happens by mistake that it's 4 years later from the previous high. So if we don't reverse this, if this keeps going down, the 4-year fundamentalists will be right, and we will have a bear market next year. I don't know how long it will last. I don't know if it will last like the whole year. But unless the money printer gets turned back on at some point next year, it's going to be a very bad year. Now, let's paint some scenarios here. I talked about this a little bit in the spaces last night. What could happen? Like, let's talk about the absolute worst case scenario. Worst case scenario is that this trend continues. We have a horrible end to the Q4 this year, and we have a very terrible Q1, a very terrible Q2 of next year, and we don't get the people that we want on the Federal Reserve before the midterms of next year. All right, we don't get rid of Lisa Cook. She somehow wins the court case at the Supreme Court and gets to stay on and vote against any money printing. And to say Jerome Powell, like he'll step down as chairman in May, but what if he stays on as governor? And he's still against the money printer. I don't think he would ever vote for you doing QE ever, unless there was a legitimate emergency. So we got some serious problems there, because in that case, none of them are ever going to turn on the money printer and get this liquidity thing turned around. And so we have a very bearish 2026. Maybe even some of 27 would be bearish as well. That's the worst case scenario. Now, what's less bad scenario? The less bad scenario is maybe we do get Lisa Cook off the board, or we get Jerome Powell to step down from the Federal Reserve as a governor, not just as a chairman, but also as a governor. So the president does get to appoint somebody to replace him, but it has to be confirmed through the Senate. And the Senate, if it's after the midterms and it goes Democrat, well, they're not going to approve anyone that the president appoints, because they're against all of that. They're against Trump in every way you can imagine. They won't approve anyone. So that's another worst case scenario where we don't get any money printer turned on till years later. Now, what's a more likely scenario? A more likely scenario is that, suppose this trend never reverses. It keeps going down, but next year, we either lose Jerome Powell or Lisa Cook from the Federal Reserve Board, and so the president gets to name somebody else, gets to nominate, and they can get confirmed through the Senate before the midterms. Well, now we got a 7-vote majority on the Board of Governors, or not a 7-vote, a 4-vote majority, on the Board of Governors that can decide to continue lowering interest rates, but then also they can influence the Federal Open Market Committee to turn the money printer back on. See, first you need a 4-vote majority on the Board of Governors, and that can then influence a 7-vote majority on the FOMC, which is 11 people. So that would be the next scenario. But in that's one, that's kind of like what I was thinking was going to happen all along. It just means that the bull market doesn't start until Q3 of 2026. And I think it will really suck between now and then, because a lot of people are just going to not be able to handle the sell pressure, the downward price action, and what's going to feel like a real bear market between now and then. Because you got to remember, like, a lot of people are going to be selling right now just because they believe, it's a bear market time because 4 years just ended. A lot of people are going to be selling right now to do tax loss harvesting. A lot of people are going to be selling in Q1 of 2026 because now they got some profits they finally want to take because it's a new tax year and they also believe in the 4-year cycle. So it will really suck already. There's enough sell pressure already between now and Q3 of 2026. A lot of people would get shaken out. A lot of people would get washed out, and it would be extremely painful for anybody that is hodling between now and then. Absolutely, it'd be very tough. So I'm hoping that this trend we're looking at here reverses, and I'm really hoping that Powell takes a dovish tone. Now, so far, the actions that they've taken are very dovish and they favor us. But the actions are not as important as the tone of the press conference. So we're going to have to really scrutinize every word that he says. All right. The thing that he's going to be asked about the most here, though, is going to be this: the Federal Reserve balance sheet. Just looking at the last 3 months, still allowing quantitative tightening to occur. Still allowing it. Looked like for a second it was totally reversed and they were doing some easing. But no, still letting the balance sheet run off. I think we got time, though, for a couple more stories here before the press conference begins. This is something interesting from the Kabisi letter. What they pointed out here is that even though the S&P 500 is at 6,900, or is it? Where is it at? Well, it's close. It's just 1 point off there, but it'll make it today, I'm sure. So even though it's closing above 6,900, 398 companies in the S&P 500 are actually down for the year. 300. So all but 102 companies are actually having a bad year. 80% of the index is red, but the index is still green. That shows you just how top-heavy and concentrated it is in just a few coins or just a few stocks that's holding that market up. Because really, it's the Magnificent Seven that's pushing the whole thing up, or really just the top 10 stocks that are pulling the whole thing up. Because the other 90 or so stocks, they're only up a little bit. Only up a little bit. So a lot of it is everything from like Nvidia to Apple that's pulling this market up. And has the index so high. So that's not much different than the situation we have over here in crypto, where Bitcoin is practically the only thing that's made any money so far this cycle. Like, where's the Bitcoin dominance at, by the way? Should check that out. 58.8. It was like at 60%, I think, earlier. But I don't know how that got down. Well, it's because the price has gone down. But, yep. Out of how big is the market now? 3.78 trillion. 58% of that is all Bitcoin. I think that the Bitcoin dominance goes up higher before it goes down and the switch goes from Bitcoin to alts. I think that still happens. But stocks are not much different than how we are. So even though you guys are probably getting very disgusted with how the stock market keeps posting a new high almost every day while crypto is sucking, what you want to bear in mind is that most of the stocks that are doing well, it's just a handful of them, and it's all concentrated at the top. And it just takes one of those companies to have a bad day for the whole market over there to suck. So don't be too envious of the stock market just yet. Don't be too envious of it yet, because what this tells you is that there's a very small amounts of money that are moving around and investing in everything. Very small number of investors that are pushing all of these assets up. The real money is not here yet. And also, when you think about stocks, what you got to remember is that what you got to remember about stocks, they have a lot more forces that are able to push them up, because there is a constant weekly remittance from paychecks, constant remittance from paychecks of people contributing to 401k plans and 403bs. So it's always going to be fed something just about every week. Like, that's what kind of guaranteed in that sense. particularly with government employees. I mean, they're going to get their money crammed into their 457B plans and their TSPs and everything. And all that money goes into stocks. All right. So I think that we can't totally compare ourselves to the stock market for that reason, just because there is a constant force pushing stocks up. And also buyback season is about to start because there's a lot of blackouts and buyback, a lot of buyback blackouts that are coming to an end in the next few days. Mr. Barbarian, I see your question. I'll answer it, but let's see. Do we have time to answer? Oh, the meeting has occurred. Hang on, let's switch to Pal's press conference.
Inflation remains somewhat elevated. In support of our goals and in light of the balance of risks,
Everybody let me know if you can hear it or if you can't hear it.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments.
Yes.
Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available
Everybody in the chat, let me know if the audio is okay, if it needs to be louder.
Prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown
Don't worry, Kirill, I will answer that question about what happens here.
of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that
so far, this sounds dovish. So far, we think he's being dovish here.
excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
Quick pause right here, everybody. The market is not loving this. Bitcoin is down to 110,000. Stocks just went negative, and the DXY went up to 99.1. Not so sure what they're objecting to just yet, but let's hear the rest.
Today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years
the Trump coins are loving this, though. They're still going up, both World Liberty Fi and Trump's meme coin.
that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
The 2-year Treasury is down. That's good.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December.
We're almost at 109,000 on Bitcoin right here. They really didn't like this question. This question was a setup question to get him to talk very hawkishly.
And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks, and I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for
We just hit 109,000, or we just entered 109,000.
some kind of improvement in the outlook? Or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way we have been thinking, way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question.
Ethereum down at 3,800. God, what a piece of trash.
We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because, you know, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives.
Okay, it looks like now they like what he's saying right here. Bitcoin is coming a little bit back. Some of the other stuff too.
Gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your
DXY is shooting up and the stocks are still going down.
perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve Leisman, CNBC.
Those Treasury yields keep climbing, both the 2 and the 10-year, only by a little bit right here, but generally that's not a good sign. The guy was that one question he took about is December a foregone conclusion? That was a hawkish answer, and I think that was a setup.
Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
Just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place will be on December 1.
All right, there's a good question that actually will get him on a dovish tone here.
One is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep.
Market's loving that question. Bitcoin and Ethereum are going up based on that, and like even stocks are getting a little bit of what they lost back from hearing that. So good on the reporter that asked that question.
Up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration.
Yeah, most of the Treasuries that are outstanding are T-bills and are very short term. That's why they're going to be investing in T-bills. So it will be like a constant reinvestment of matured money into those T-bills. It will feel like quantitative easing, actually. I'll tell you about this later. I'll show you an example.
Balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused.
Bitcoin back at 111,000, almost right back to where it was before this whole thing started, which is interesting because, like stocks, we can't really say the same for them.
For all of this year, at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, you know, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation. Yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, you know, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and I mean, financial services that are imputed rather than actually paid is a big part of that. But also just, you know, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because, you know, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Bitcoin dominance is going up. It's back above 59% as Bitcoin keeps going on up. So Bitcoin people really like this and what they're hearing. Ethereum's regaining some of what it lost, but never should have lost what it lost in the first place. Many of the altcoins, though, they kind of stayed right where they were before the press conference began.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles?
What a stupid
How is the Fed
question.
thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data, that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
You know, this is a temporary state of affairs, and you know, we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that you know, what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get.
They're really baiting him to like speak hawkishly here with the questions that they're asking.
The data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up, in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, you know, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things you know, that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and you know, yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, you know, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Treasury yields are climbing 4.05% on the 10-year.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, you know, we've now moved 150 basis points, and that we're down into you know, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you know, you can argue these positions since it can't be directly observed, the neutral rate. So, you know, I think for some part of the committee, you know, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, you know, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others, wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look,
I can tell you what he's going to say. He's going to say both are important because that's such a stupid question.
everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through, through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Scholzley with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and I would just say when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, they've been coming into effect consistently in February, March.
Bitcoin is safely above 11,000, and Ethereum is just $50 away from 4,000. So it's almost as if it's back to where it was before the meeting.
April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are 1/10 or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued?
And Matt, they already announced that it's a 25 basis point cut.
At this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help.
Except that ain't happening. Check the markets, dummy.
The labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different in the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor
So
market?
we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims, are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
that we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider.
Finally, a good question. I got to ask about the presidents of the 11 different banks. This is important because this tells you who's going to be in charge of the Federal Open Market Committee when after February.
Those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Doesn't give us anything we want to hear. Well, there's not much he could say though, because might not have Lisa Cook on the Board of Governors when that decision is made, but that will be something to watch out for in February for sure.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, looks like that's the end of the show here for Jerome Powell. Now, let's talk about what this has caused. Let's see, what we're going to do is we're going to go back to the market, share the screen here, and see where are we at with Bitcoin, the stock market, and everything. How did they react to all of this here? Oh, by the way, the 10-year Treasury is up to 4.05%. What that means, actually, those that we officially have a little bit of a spread now between the 10-year Treasury and the federal funds rate, because federal funds is now at the high end, it's at 4%. So we have 5 beeps in between the two. That part is actually good. Now, how's crypto absorbing all this information? Well, on the day here, Bitcoin is down to just it's down 2.4%, but it doesn't look like it got hit that hard. Oh, it's going down now. It's down into the 110,000s. I can easily recover that, though. Ethereum sucking as usual. Nothing good. Nothing nice to say about them ever. Everybody else, though, it's not much of a change right here. I think it's kind of a disappointment here, though, is Solana, because they just had an ETF released, and they're really not doing anything special because of it. Not that I think that ETFs really do anything for us, because remember, when the Ethereum ETF got released, Ethereum did nothing but suck ever since. So Solana, I'm not really expecting the ETF to be doing a lot for it. But see, as far as everything else goes, well, World Liberty Finance is still up, and Trump Token is still up. Those guys are doing just fine. My guess is that some insiders over in the Trump camp knew all about what was going to happen, and were trading ahead of it. They believe that it's bullish for crypto in general. Like, you would not be trading Trump Token, the meme coin, unless you believed that the overall direction of the crypto market is going to be bullish, because there's really not much reason for that coin to exist other than to capture an overflow of a lot more investment capital coming into the markets. But kind of be like the additional bucket you put out there to catch all the extra money coming in. And let's see, as far as everybody else goes, well, everybody's really still kind of where they were from the very beginning. No dramatic moves here yet, other than the drop down to 110 into to the 110,000s. That's like the most dramatic thing off of it. Not much changing here in the RH ecosystem. And when it comes to stocks, how are we doing there? NASDAQ is up. The Dow and the S&P are down just slightly, very slightly. And I tell you what, like, it is all because of that one douchebag reporter at the beginning of the meeting that asked the most douchey question. See, they say who it was. I forget who it was. But yeah, some douchebag reporter gets up there and asks, are you comfortable with the fact that the markets are pricing in the December cut as a foregone conclusion? I mean, first off, what a stupid question to ask. Incredibly stupid question. Let's see, how's the CME group reacting to all this here? It's like, what do you expect him to say? You expect him to say, oh yeah, because like the markets that, because of like the trading markets and everything, because they're pricing in another cut, well, I guarantee there will be another cut. You guys expect him to say that? He's not going to say that. All right, so we take a look here at I don't think that they updated the current rate yet, did they? Yeah, they haven't updated it yet. Okay. So it says here they're still pricing in 88% chance of a rate cut. Oh, wait, this is the October 29th meeting that it's talking about. We got to go to the 10th? Okay. Yeah, that one's come down here to just a 59, practically 60% chance of a rate cut occurring then. Guys, it's 45 days away. It's too early to tell. Or really, it's 41 days away. So it's too early to tell. Way too early to tell. All right. As far as like his tone goes, I did not hear anything way too hawkish, but apparently a lot of investors did here because they're selling down some Bitcoin. Down to 110,600. We can't really conclude anything here from it yet because like still all this information's got to get disseminated and digested by the market here. So we can't say nothing yet about was he hawkish or was he dovish in that sense, and like is it good or is it bad for the overall market? Can't make that conclusion just yet here, but we will talk about it a little bit when I come back. But first, little public service announcement.
Why does crypto suddenly explode into unbelievable bull runs, only to crash just as fast? It's not luck. It's not random. It's macroeconomics. In Decrypting Crypto, you'll uncover the hidden forces driving every major crypto rally, forces tied to the global debt machine, central bank liquidity, and repeating market cycles. This isn't another blockchain basics book. This is the blueprint Wall Street doesn't want you to read. The playbook that shows you why crypto moves when it does, and how to spot the next bull run before it starts. Don't miss the next cycle. Read Decrypting Crypto. Arm yourself with the knowledge to ride the wave before it leaves you behind. Decrypting Crypto by Cairo Code. Available now on Amazon and Audible.
All right, so it looks like we're kind of landing at 110,600. So you know what? I got another public service announcement for the entire market. Hey, all you guys that are selling right now,
Control yourself!
hold it in. Let the information get disseminated here. All right, so was this good or was this bad?
A legitimate question, young man, deserving a legitimate answer. Now then.
That's a very good question, but I think on the whole, for the most part, this was good because they did give us a date of when to expect the end of quantitative tightening, which will be December. However, it's not as good as it could have been. We could have been experiencing that right now had they announced it now, and a lot of people were expecting it to occur right now because JP Morgan said that it was going to be announced today. It didn't get announced today, so now we're going down here a little bit more, down to 10,500. We were down in the 400s there for a little bit, so need Margaret Qualley to lecture everybody again here. Margaret?
Control yourself!
Man, Mark is going to be looking as ugly as the protagonist in the movie that's from in The Substance, if y'all do not learn to control yourselves here. So, nothing like really stood out to me as particularly moving other than, hey, we'll stop the quantitative tightening come December. Now, I think that probably why the market is reacting so negatively here to it is that he said, well, a rate cut is not guaranteed for December, so they conclude from that the quantitative tightening is not guaranteed to end in December either. Seems to be the conclusion going on here with everyone. What does CNBS have to say about this? Anything? Still just the same old thing here. They had to get that stupid question in so they could get this headline. Dow dropped 200 points, giving up gain after Powell signals Fed may not cut again this year. That's the whole reason why that question was asked. It was a really stupid question. They did it specifically to get that headline and to cause some drama. Looky here. The DXY is up on the day. Not up too much, but man, when that press conference started, look at this shoot up right here. Whew, shot right up. Oh, man, 2-year Treasury at 3.6%, and 10 years still at 4.05. Now, why do I make such a big deal out of the spread between the Treasuries and the federal funds rate? This is why we don't want this thing to go inverse here. So let's take everything out except for the federal funds rate and the 10-year Treasury. And when we take a closer look here at this, here's what we notice is that just before the spread reverses, or right when it reverses is what I should say, when the spread reverses, like at first you have Fed funds rate above the 10-year Treasury, you'll see in most of these periods here. Notice it's right before the shaded gray areas. What's going on there? Why does that seem to be very consistent over the last 25 years? I'll tell you exactly why. What's happening is the Federal Reserve is realizing they are behind the ball, that they are not setting the correct interest rate policy, and they're learning that the hard way, and they got to immediately shoot and push those rates down farther and push them down faster to get where they believe they should be based on the economic situation. It was based on the economic situation, all these circumstances, everything was sucking. So here was like before the 2000 recession, right? And here's going to the recession that kind of went up through 2001 all the way till the end of the year. The Federal Reserve had the Fed funds rate, which is blue, above the 10-year Treasury. The 10-year Treasury is growth and inflation expectations for the economy. When that is lower than the federal funds rate, the market is trying to tell the Fed, hey, you stupid people making the decisions over there at the Fed, you stupid people have the wrong interest rate policy. You need to reduce it further, faster, because we're already reducing the interest rates that we believe are the correct ones. And so when it goes down dramatically after, we're in a recession, but eventually things get going right, because the economy from about 2002 all the way up to 2007 was very good. Now, in 2007, 2006 is when it started here. That was where policy got restrictive, and it was too restrictive for too long, because look what happened next year. Like, they were above the 10-year Treasury. And because they were above the 10-year Treasury for as long as they were, the market was telling the Fed, you're behind the ball. And it became very clear that they were behind when the 2008 recession hit, which was right here. Boom. So the Fed had to dramatically drop the rates and do it again, all the way down to almost zero. And then the same thing happened over here in 2020. So when you've got the federal funds rate above the 10-year Treasury, that means the Fed is being more restrictive than the economy is telling them they should be. The economy is telling them, hey, you don't need to be that restrictive. Just follow the 10-year Treasury. The Fed says, oh, screw you, we know better. That messes things up. It's really why this whole cycle has been sucking ever since 2022, because it's the Fed basically saying, we know better than the free market. And so they had an extra restrictive policy. But right now, I think that we might be experiencing a flip, because like the rates were neck and neck just now. Now the effective federal funds rate is 3.75%, or the lower bound end of it is 3.75, which is still, it's not reflected yet in this here. It will be, though. Goes into effect tomorrow. Oh man, the chances of a rate cut in December are going down here. It's down to just 54%. So we're at roughly 3.75 right now, which is lower than the 10-year Treasury at 4.05. But remember, it's a range for the federal funds rate. It's 3.75 to 4%. So the only spread amount that's guaranteed is 0.05, which is not great. Let's see, crypto's not nosediving much further yet here. Still seems to be on a downtrend, but it's not dying. It's not October the 10th. Now, here's what else we got. Like, this is behind by 2 days, so this will be interesting to check in 2 more days here. This is the spread where it talks about like the 10-year Treasury minus the federal funds rate. So far, we have had it go below by just a little bit. Now, to show you just like how much this matters for crypto and why this matters for crypto, just check out the times where the spread was positive, meaning 10-year Treasury minus federal funds rate is a positive number as opposed to a negative. And looky here. December 19th, things were still good in crypto land during that time. Still, December 19th, 2024. And it had kind of been that way throughout most of the month of December. Like the first half of December, everything was good. Because what was happening is that the 10-year Treasury was rising as they were cutting the federal funds rate. So I remember like last time I looked at my portfolio in late December thinking, oh man, this looks really nice. And then, of course, it all went down the drain. But when we go back to March of 2025, things started sucking again, sucking pretty bad. Especially right here. Early April, things were really sucking because of that stupid Liberation Day. Then, come May, things started getting better. And then in July, things were better. But here's like the real trick here is like, we take a look at this. Last time that we had a positive spread was October 6, 2025. That was the last time we had a new all-time high in Bitcoin. That's how closely these things go together here. And I think that if we just keep looking further and further back, we'd see this pattern kind of repeat itself over here. Let's go back 10 years. Like practically throughout all of 2020 to 2021, and even a little bit of 22, there was a very positive spread there. And remember those times very fondly because they were good times as opposed to just before. Yeah, check this out here. Last time it was negative, last time the spread was negative was in August of 2019. Yeah, what else was going on in 2019 relevant to the Federal Reserve and Fed policy? Well, as you can see, throughout all of 2017, they kept the balance sheet flat. And then throughout 2018, the quantitative tightening began there. And that's why 2018 was a sucky year for crypto. It was really rough. Like a lot of us that were here at the time, we actually thought this was the end of crypto. We thought Bitcoin was legitimately going to die, or many of the altcoins like Ethereum. We were thinking it was all legitimately going to die because of how long this tightening went on for. And just how powerful the tightening was. I mean, we were at 4.5 trillion to start with, going all the way down to 3.7. So we've done a lot more tightening than we did here, but this was considered a lot of tightening at the time. Now, in September of 2019, they reversed course and started easing because there was drama in the repo markets, which just means that liquidity was getting way too tight. There wasn't enough money to keep the banking system going, to keep it going the way that they liked it. So that was where they had to reverse course and start doing quantitative easing. What then happened with crypto when they did that? Anybody remember what happened starting like September 2019? Let's start with Bitcoin. I'm going to go all the way back. Just single out the year 2019. All right. So here we started having a lot of positivity in crypto earlier in the year. Then kind of gotten back into a bear market. We were at 7,000 by the end of November of that year. Then we started coming back. I mean, this whole thing right here, going from, this was quite a move right here, adding 10,000 to the price tag. In February 2019, we were only at $3,600. It's almost like we got a mini bull run right here, going all the way up to 13,000. So if you had held it right there, you would have at least 4x your money practically up until June of 2019. What caused that spike in June, though? Like, that seems quite dramatic. I think that by then they had announced that they were going to stop quantitative tightening. They didn't really stop doing it until September, but the announcement was probably made earlier. All right. So, late 2019, they stopped the tightening, and that did have a very positive effect on crypto as a whole that was felt months later, because they kept things kind of right where they were as far as the balance sheet goes from December to February of 2020. How did Bitcoin perform in that time? Let's see here. Did have a mild run up from 7,400, or really 6,900, up to, what do we got here? 10,000. All right, things were going good. Then came the pandemic, kicked us right back down to $5,000. We could be seeing a similar setup here with this. Like, when the Fed decides, hey, we need to stop the tightening, we might have to do a little bit more of the easing, that is usually preceding something. They don't just do it because they're like, oh, we've done enough tightening now, let's do something different. That's not what it is that they see trouble ahead, just like they saw here. And you're like, well, how could they have predicted the whole corona thing? Well, it's not that they were predicting that, because you got to remember also that the bond market was telling them that a recession was coming too, because the yield curve had inverted long before all of this right here. And a lot of people think, well, the reason the yield curve inverts and how that usually predicts a recession is because there's lots of inside information. That's the insiders moving their money into bonds. Same kind of went on here with the Federal Reserve reversing their policy on the balance sheet. All right? Because it kind of happened right around the same time there. Now, hopefully, we also see a reversal here in Fed net liquidity, because this chart should give you nightmares. This should send chills down your spine. All right. So, let's see, where are we at here? 10,800, 10,700. All right, the rest of the market's kind of right where it was the whole time. Seeing a lot of more green, but we can't really pocket that green as like anything to write home about just yet. Because a lot of this green here is kind of right on the border. Like, oh, wait, EtherFi, what's going on with you? Interesting, up 5% on the hour. All right. Good for you, because you guys being priced below $1 right there is unusual for EtherFi. All right. How about this Trump token, up 20% on the day. So I'm looking at Trump token going up 20% on the day of a Federal Reserve press conference. And I'm thinking, well, that's got to be insiders buying it, and they're bullish on crypto as a whole here, so the rest of us should be bullish. Because, man, I don't know that many normies out there that are buying Trump token. All right? I don't know even people that are deep within our community, the crypto community as a whole. I don't know that many crypto people even that are buying Trump token. Now, you want to know when we're really in a bull market, though? I'll tell you when we're really in a bull market, when Melania token starts doing very well. Matter of fact, let's look that up here for a laugh. Because if Melania token is doing well, well then, we are back in whoa, holy smokes. It's up on the day by 8%. Okay, that's not great, though. It's not great because there's so little invested in this thing altogether. I mean, market cap's just about a little over 100 million. Still, something like, oh man, and was it? Okay, this was a few days ago. Had a little pop here just 2 days ago. I don't think this is normies. I mean, it doesn't make sense here for World Liberty Finance, for the Trump meme coin, and for the Melania meme coin, all three of them to be popping off all around the same time with a Fed policy decision just a day away. It doesn't really make sense to me for these to be happening randomly, or for it to be normies, or for it to be regular crypto people. To me, this has got to be insiders. And look, yeah, on the same day, the October 27th, this guy had a pop. than our pop today. Interesting. So we'll soon find out just what's going on with them. Okay. Athena's there, Hyperliquid there. All right. Anything new here from nothing new here from CNBS. Oh, Microsoft is experiencing an outage in their Azure thing. I think I'm switching to Linux. I think I'm going to be switching to Linux pretty soon here because I'm tired of like all the annoying things I see from Microsoft. They're constantly annoying you to use their stupid Copilot program. No, I don't want to use your stupid Copilot program, all right? All right, and then how is the predictions for rate cut in December? 55%. All right. Okay, dollar index is going down just a little bit more. 2-year Treasury shot up there. Okay. Oh, the 10-year is going up a little bit higher at 4.06%. All right. So that's quite a mouthful of information right here. There's some smart stories that we wanted to kind of hit at today here. See, here was kind of like what the market sentiment was about this all the time right here. It's just that the rate cuts were priced in already for the year. QT slowing down or coming to an end, that was kind of already known. Probably not priced in, but it was known. A deal between Trump and Xi, which would be tomorrow. If it happens, it'll be announced tomorrow. That is something that everybody kind of expects because, like, a lot of this is wrestling. It's pro wrestling here, the trash talking between the two of them. Now, if they made any hint of doing quantitative easing, that would pump the markets, but we didn't really hear that they anything about quantitative easing. Just steady sheet maintenance. So there's nothing really special, nothing to really move the markets in an upward positive direction today here. But the big important thing was that they did not have a super hawkish tone that would make me worried. If it was very hawkish today, with Fed net liquidity tricking down, that would be a huge problem. Now, here's something interesting. This comes from Crypto T, and I really liked this post right here. I don't always agree with Crypto T right here. I think she's a Bitcoin maxi, so I don't always agree with her, and I don't agree with her on her price predictions here and everything. But for the most part, what she is saying here is what I've been saying all along. So whenever you see two people who usually disagree with each other finally agreeing on something, you can rely on the fact that that's probably what they're talking about and what they're agreeing on is true. So what she says here, Bitcoin has been in a bear market for the last 4 years. That is right. We've been in a bear market this whole time. Just because you went from 16,000 to 110,000, that doesn't really mean nothing because most of that money came from Treasury companies and ETFs. And institutions. So what's back to what she was saying here is that we've been in a bear market this 4 times because the Fed has sucked liquidity out of the market and made it expensive to borrow money by raising interest rates. And to show you that is true, we got to take a look at Fed net liquidity for the past 4 years. They sucked a whole lot of liquidity out of the system in the year 2022. They had some parts of we had some instances throughout the past 4 years where they let it peak up, but they brought it immediately right back down. This is why the market has been sucking. Check this out here. Look at this one peak that we got here. March 19th, 2023. Anybody remember what happened in March 19th, 2023? Anybody remember something that was very eventful on that particular month, and then also a little bit later in April? Anybody in the chat want to say? Anybody on the chat there? Everybody want to say something about that? When what occurred back then? I'll show you. I'll show you what happened. See, let's go back to. Let's start with Bitcoin. Let's look at Ethereum. Let's look at Cardano, since they're the polar opposite of. Oh, hey man, I've seen a lot of green right here. This is really nice to look at. I haven't seen a lot of green in a long time. And let's look at Hex on Ethereum. All right, so let's check out the 2023, the month of March. What happened was we started climbing. And then in April, we kept climbing. That was Bitcoin. How about Ethereum? In Ethereum, we had practically the same thing going on right here. Let's see. March, we hit a bottom on the 9th, but then we started climbing. Then hit a new high for the time, a new high for the bear market high on April 15th, April 7th. Yeah, April 15th is when that was. Cardano, polar opposite of Pulse Chain, kind of like our arch enemy here. Look at this. They hit a bottom, not on the 9th. I mean, yeah, they did hit a bottom on the 9th there at 30 cents, but then they kind of went a little bit lower on the 11th. Then they started climbing. Finished March positive. And then looky here. April 15th, they go right on up with Ethereum. Doing pretty good there. Now, what about Hex? We didn't have Pulse Chain back then. We only had Hex on Ethereum. What did that do around that time? You guys all remember it going from like 2 cents to practically 12 cents in March. That's why it's all related. Some people said, oh no, that's because of V3, Pulse Chain Testnet V3 announcement. I would concede that point if the rest of the market didn't go up with it. But since the rest of the market went up with it, I'm like, no, this was something separate here. And also, when V3 is announced here, like, if that's really that bullish, I mean, V3 didn't go away the next day, so why would it go down the next day by 4 cents? And still, this stayed pretty strong throughout the majority of April, like the rest of the market. So that shows you, and that kind of proves my point, that this Fed net liquidity is what really matters. Just look at this here. Look how well everything did after all these liquidity injections. And when the liquidity is taken away, when they kind of pull the rug on it, well, that's when everything starts going down, because like they pulled a ton of Fed net liquidity by the 23rd. So later into April, we started grinding down here. It's all related to liquidity. It is the only thing that matters. Say it a gazillion times. It's Cairo's law. Liquidity is the only thing that matters. All right, so back to Crypto T here. So what else she says here is when Jerome Powell is replaced and max liquidity cycle will begin, where Bitcoin hits 1.2 million. Now, I don't agree with the price prediction, but I do agree that if Powell not only steps down as the chairman, but also as the governor, and he gets replaced, or if we replace Lisa Cook before then, we're in good shape. We're in great shape, absolute great shape, because that will start a new liquidity cycle, because the people that are going to be on the Fed at that point, they're going to be in favor of increasing net liquidity. To compete, a central bank digital currency will be introduced and an airdrop will be offered for people to start using it. The airdrop will spiral us into hyperinflation, where Bitcoin hits $5 million per coin. Now, hyperinflation is a word that's kind of thrown around a lot more than it deserves to be. Hyperinflation is where you're talking about wheelbarrows full of money being taken down to the supermarket and you're still too late because the price of a bagel doubled and your wheelbarrow of money is not going to be good enough to buy it to buy the bagel. So it would inspire us into a lot of inflation, absolutely, but not hyperinflation. It would inflate the market. That would be good for crypto prices. People will start to wake up and refuse to use fiat, at which point you will not be able to buy Bitcoin with dollars. Don't know if that was the case. I mean, it's world reserve currency still, even in that scenario. To combat this, the state will become violent and capture the Bitcoin on the stock market from strategy and the ETFs. I do think that could happen, But that would happen under a Democrat. I think that's something that would only happen under a Democrat. Not your keys, not your coins. Cold wallets and bullets, good luck. All right. So about 60% of this post here I do agree with. Now, as far as the liquidity that we've experienced and what has been pushing Bitcoin up this whole time, it all comes from China. All right, because take a look at this here. Like, the amount of money creation, this is all global M2 that we're looking at right here. But down here in the black, this is United States M2. And really, it's not been that much since 2022. I mean, really, we just got back up to where we were in 2021, and that's it. The rest of the world, though, I mean, the brown here, the crap brown, very fitting that it's crap brown because these are the other countries in the G10 except for the United States. This is how much they've added. China is really just getting started. They've added the majority of the liquidity so far this cycle, and they're not even as high as they were back in 2021. Their M1 money supply is nearly $10 trillion, and it's 25% of the world's total M1. M1 is basically money in your pocket and money in bank accounts. All right, money we can easily get to. This even surpasses the US M1 of $8 trillion, and the global liquidity expansion is currently coming from China, driving this cycle, the current economic cycle that we're in. Now, here's another thing. What we've seen so far, all done by China's M2 growth, China's money printing is not a big helper of financial assets. Most of China's money printing, they print the wons, the yuans, and they inject it right into their local economy, their real economy, because a lot of it goes into the construction of housing, the construction of those ghost cities. And it's just meant to put the Chinese nationals to work. So most of the money printing that China's done has not gone into financial assets. So for us to pop like we have from the amount of money that only China has been printing, and then also the fact that not much of that printed China money has gone into financial assets other than gold, well, it's incredible that we're at where we're at right now. Incredible. We should be grateful for these prices here. All right. We'll come back to this here, and we'll get into all your questions. But first, let's have just one more public service announcement. You're listening to a Reinvent Ideal live stream. The phrase Reinvent Ideal isn't just clever wordplay. It's a manifesto. For decades, society handed us a dusty old blueprint for life. Work 9 to 5, climb a corporate ladder, buy a house you can't afford, marry young, pump out kids, spend 40 years in a hamster wheel, and if you're lucky, retire at 65 with a gold watch and arthritis. That's the ideal we inherited, but it's a lie. A boomer-delivered illusion that made sense in 1970. But in today's world, it's a recipe for debt, burnout, and disappointment. Reinvent Ideal is the antidote. It's about rejecting the outdated script and designing a new one. A life where freedom, autonomy, and leverage replace status chasing and financial enslavement. Where your ideal isn't dictated by suburbia and social media, but what keeps you sane, sovereign, and alive. Instead of status symbols, we pursue rare and in-demand skills that buy independence. Instead of debt-fueled materialism, we choose minimalism, shedding liabilities and obligations. Instead of working to death, we embrace crypto and investments that multiply freedom instead of shrinking it. The new ideal isn't about fitting into someone else's mold. It's about building a life that maximizes your time, choices, and sovereignty. Reinvent Ideal is about giving yourself permission to redraw the map. All right. So the next thing here to look at as far as the whole liquidity picture was what was shared recently on X by Julian Biddle. And Julian Biddle, he's one of these guys that he's kind of with Raoul Pal about what they call the everything code, but basically just means that liquidity is all that matters as far as they see it. So, says we've seen a small tick lower in our GMI total liquidity index this month. I don't think I'd call it a small tick right here. I mean, look at from July 20th all the way to now. It's almost a full, or it is $500 billion there in lower liquidity. Not good. But here's what they say. That lower rates then feed through, or wait, he says, remember, weak, lagging employment data is what keeps the Fed engaged, or more cowbell. Lower rates then feed through to more rate-sensitive and leading areas of the economy like housing, and this drives the business cycle higher. Now, it's not that people are going to start buying houses, but what it does mean is that if the rates are lower, people may take out a second mortgage or a HELOC and then use that for spending in the economy. This drives the business cycle higher. It's a recursive feedback loop. Once the shutdown ends, liquidity taps open again in a big way. We'll see the TGA spend. Now, that's another thing here is like the reason why liquidity is going taking a nosedive. A lot of it's due to this government shutdown because the Treasury general account is filled up, and all that money is just kind of sitting there in purgatory waiting to be spent. It's not being spent right now because the government's shut down. So when the government reopens, that will be positive for the markets. Let's see, rate cuts, the end of QT, probably a repo tweak to ease tightness. Talk of ESLR relief in January, and a pivot back to ample reserves regime as QT winds down. That's a wall of liquidity coming, and that's just the U.S., okay? So that's true. A lot of good things on the horizon for reversing the Fed net liquidity, which we really need to have happen. Really need to have that occur. It feels to us that the lead time of financial conditions, looking at the chart 1, which let's pull that up here. So this, let's see, GMI Financial Conditions Index. Probably got that from the Chicago Fed. That's usually who comes up with those indexes. What do they say here? May have actually increased a little since the start of 2023 versus the GMI the total liquidity index. I'm not going to adjust it to overfit the chart. It's almost a perfect fit. Yes, that's true. As a reminder, this is how the phasing works between financial conditions and the ISM. So they added in the ISM kind of business cycle tracker, which has been going kind of sideways, oscillating back and forth here, right on the borderline between recession and a roaring economy, or a good economy. All right. So the view that the liquidity cycle will peak early next year isn't going to be right. It feels too early for that. And here's his explanation. The everything code's debt refinancing cycle plays out in two major phases. Here's the big deal. It's like when you have a lot of debt that needs to be refinanced, which the United States, just the government itself has a lot of, you're going to need a lot of liquidity to refinance that debt. Because you're looking at a liability on one side of most balance sheets, and then you got to have the ample assets on the other side of it, meaning money in the system to play with. In China, phase 1 is where rates need to come down first, which is happening right now. In China, that's largely happened over the past 2 years as the economy struggled, with 10-year yields falling from around 3% at the start of 2023 to 1.6% earlier this year. I pushed back pretty hard at the time against the consensus view that the collapse in rates was bearish. Instead, I argued it was a massive easing of financial conditions coming from the East. Now that that's happened, phase 2 can play out. Debts can be rolled over at more sustainable levels, with the dollar now weaker. Well, it's weaker on the year. It's a little bit weaker on the year here. But the PBOC can deploy its balance sheet, which this month hit a record high and could reach $8 trillion by the end of 2026, which is this chart right here. So the PBOC, basically China's Federal Reserve, they are printing money, and they will have to continue printing the money. Because here's the deal: is like, look at the yield on their Treasury bonds out there. They're going to need to have money. They're going to need to have money in the system to pay that kind of interest rate. Because that's the yield that we're looking at there. They're going to need to have money in the system to pay that interest rate. The only way they have the money in the system to pay that is going to be through printing that money. And also, like, as those yields go down, it seems that kind of frees them up to print more money. But they work together here. As you print more money, the yields go down. The interest cost is less when the Chinese yuan has a lower purchasing power. All right. So China playing a major role. And let's see, this could continue all the way up until the end of 2026, which Biddle sees as the end of the liquidity cycle, which would be the end of our cycle here in crypto as well. It's also worth remembering that back in 2017, the Fed was hiking rates and liquidity injections were basically flat. So was the balance sheet. It was flat. The real liquidity came from the PBOC and, to a lesser extent, the ECB and the BOJ. Well, we know the BOJ is going to do it, but we don't know about the ECB yet. Yet, despite the Fed being sidelined, Bitcoin and other risk assets ripped higher. Everyone is too focused on the U.S. and what the Fed is doing. Well, the reason why that is here is because you got to remember the PBOC, when they print money, that goes into the real economy, the industrial economy of China, whereas when the Federal Reserve prints money, that goes into financial assets faster. So that's why everybody's so fixated on what the Fed does. What really matters, though, is the total liquidity of the globe, as long as that continues to trend higher, because that captures all of it. Additionally, our GMI Global Excess Liquidity Composite measures how much liquidity exists in the system beyond what's being consumed by nominal GDP. This excess liquidity can be, and always is, financialized, meaning it always ends up in financial assets. That's that demonstration I keep doing, where I keep say, well, this dollar bill goes here, and then it goes into this person's hand, this person's hands, this person's pocket, then into this person's bank account, and then into financial assets. If you look at this chart, since the mid-1980s, equity valuations have tracked almost perfectly, roughly 6 months behind with excess liquidity. And that's this one here, where it shows like PE ratios for the stocks. So still bullish. The delay in the TGA drain and the Trump tariff scare on the 10th have been painful, but ultimately they're just noise. We believe a more dovish Fed, rising PBOC liquidity, and strong Q4 seasonals are all lining up to push this market higher into year-end. At the end of the day, it will always come back to liquidity, and we still see liquidity rising. I hope you guys are right, because right now I look at this chart and I'm not happy with what I see there. We'll have to check this. We'll have to check back at this chart here in about another 2 weeks to see if it's reversed, because it's always 2 weeks behind. But that is true. It is all about liquidity, and it's all about global liquidity. So as long as it keeps going up and what they had outlined in that post plays out, well, then yes, we continue longer. Now, here's some more. Here's something more to be bullish about. France stuns Europe. Could lawmakers adopt Bitcoin and ban the digital euro? Remember how I kept talking about France and how that's a very important thing going on in the world, and how France is in so much trouble, and you should pay close attention to what's going on in France. And let's see. Oh wait, I do share this tab instead. Yeah. This is why. There's so much there's so much going on with France. There's so much destruction. The problems they have are only going to be solved by money printing. But it looks like they're trying to solve it another way here. France wants to use Bitcoin as basically a sovereign asset, endorsing Bitcoin and the use of euro-denominated stablecoins as opposed to ECB's digital euro. Now, when France speaks up here in the European Union, everybody tends to listen because they make up such a big chunk of the European Union. And this whole ECB digital euro is not going to fly because Brussels is very unpopular. The EU is very unpopular with the average European. Ursula von der Leyen is probably one of the most unpopular politicians out there. So is France's Bitcoin reserve plan a defense of freedom and a rebellion against, or a rebellion against Europe? Well, it could be right here. So far, this is all just a proposal. But if they're going to act on it, they're going to need to act on it pretty soon here. Let's see. The ECB is currently in the preparation phase of a digital euro, which began in November 23 and is expected to conclude by the end of 2025. The currency could enter circulation around 2029. So if you're going to try to counter this here, they're going to have to do it pretty soon. France calls on Europe to break dependence on US dollar stablecoins. So now they want to actually get into a capital war here with the United States, which they will not win that. Not when France is losing 200 billion euros a month. That's the capital flight that they're experiencing. All right. International Monetary Fund data reports notes that 91% of global stablecoin capitalization is denominated in U.S. dollars, primarily through Tether and USDC. That will continue. There is nothing that the Eurozone can create that will rival that. The leading Euro stablecoin holds just $259 million in market capitalization. Yeah, because the Euro itself is in a lot of trouble. France strengthens its crypto framework ahead of the MICA implementation in 2026. Yeah, if they're going to do a strategic Bitcoin reserve, they're going to have to do it pretty quickly. I'd like to know what money they're going to buy it with, though, because they really don't have any money in France. Let's see here. Anything else important in this story? No, nothing else. All right. Let's get into everybody's questions here. I know you all have been holding your questions throughout all of this. Oh, I want to start with this. Back in the game says, bull run is over. It never started, so I don't know what bull run you're talking about. Layoffs are everywhere. Recession is imminent. Okay. Yeah, I can agree with that. A recession. I mean, I would say we're in a recession the whole time. It's just it's bifurcated because the economy is bifurcated. But if we go into a recession, do you think that Trump is just going to let that recession go on and play out its natural course? You think that the central bank, that the Federal Reserve is just going to let it go on? No. I mean, hey, take a look at just what happened with the 10-10 sell-off. It was just a day later where Trump gets back on and says, oh, yeah, don't worry about the tariff I'm going to put on China. Like, they will not tolerate even a 3% decline in the stock market. Trump does not want to preside over a recession or over a declining stock market. Definitely not a declining crypto market because he's bet so much of his presidency on it. Mr. Barbarian asks, what would need to happen to get a pump by the end of the year? You need a reversal in Fed net liquidity. That's the easy answer. You need a reversal in that. Because right now, if that thing keeps trending down, the market's going to suck for the rest of the year when that's the case. Okay. Tom Rudders asks, is the man, the myth, the legend, Mr. Cairo? I don't know. Am I a myth? I don't think so. Appreciate that, Tom. Reef Juicy says, reverse repos are close to zero, meaning banks are out of cash. Let's look for clues about the Fed injecting liquidity like they did back in September of 2019. Yes, we took a look at that. That could happen again. We hope that it does. Let's check out the what's the market doing right now as we speak here. Is there any change? Bitcoin back at 111,000. That's good. Still absorbing all of this here. Were there any other questions that I didn't get to here? Oh, hello, Fast Abdul. Says that he just came here for the tech. All right. And then Hextralian Stu says, every rate cut dumps. Yeah, this is something that is important to kind of point out right here is like, rate cuts are not really helping anything other than the stock market. And even that, like, is the stock market still down on the day here? Yeah, it's still down on the day here, but that's also because, like, there's earning reports that are coming out today. Or it closed down, or S&P closed flat, actually. But, tomorrow we got the tariff decision, or the Trump-Xi meeting, and possibly an announcement from that. Lots of earnings reports coming out today as well. And really, November the 5th is probably the big day, because that's when we find out, like, hey, do the tariffs actually stand? Because the Supreme Court is going to address that. So the rate cuts are not able to override any of that. They're not going to help against any of that. Unless we had, like, a rate cut that was greater than expected. Now, that would do something. But for the most part, like, we had a rate cut in September. It didn't really help the market that much. We had a rate cut in December. The market actually took a dump after that. We had a rate cut in the previous October. Didn't really do much for us. Kind of traded flat. And then the September before, we did have a nice pop from the 50 basis point cut. But they immediately got dumped right back down. So rate cuts are really not doing what they're expected to do, which is make the market pump. And the reason for that here is that a rate cut is just determining what the cost of capital is. It's not money printing. It can help expand the amount of money that's available out there, but it's not immediate. It takes time for rate cuts to have an intended effect. And also, are rate cuts really that great for the economy? Because, like, we've had that whole higher for longer thing. That's actually probably come to bite us in the butt now, because this high interest expense coming from treasuries and then everything else on top of it, every other kind of debt has got a higher rate now because of the higher federal funds rate. All this interest that's being paid. Do you think that maybe the recipients of it have grown quite dependent on that interest payment, on that interest income? Because remember, one person's spending is another person's income. So the interest expenses that have been paid as a result of a higher federal funds rate has meant more income for the people that are receiving that those interest rates, those interest payments. And once you start taking that down, well, that's less income for them. Wouldn't be a problem if the rates were high for just a short period of time. But remember how you kept hearing Jerome Powell say higher for longer? It may have gotten to a point where, like, the economy and recipients of that interest income got pretty comfortable with it. And now they're going to have to adjust. And they don't like adjusting. That could be the case. I'm not saying that that is here, but that's kind of probably why. That could be a reason why the rate cuts are not doing that much for us. And really, to have a rate cut that really does something for us, you got to have one that's greater than expected. First, we actually would dump. We would dump on that, because it's just like that chart I was showing you about the yield spread between the federal funds rate and the 10-year Treasury. We would dump at first, because what's being learned and communicated through that rate cut is that the Federal Reserve is behind the ball and they're late to making the right decision. All right. But we got to watch that yield spread for the next couple of days here, because that will kind of tell us, does the rest of this year suck, or is there hope? And then does the beginning of next year suck, or is there hope? Find out. So don't think of me as being bearish here or trying to FUD anything, because I'll tell you what.
Sometimes you just gotta shut the FUD up.
I'm not bearish. I didn't hear anything to be bearish about today. But that trend in Fed net liquidity needs to reverse. It better reverse soon, because that is a really bad thing to look at, is that chart declining. All right. That's all I got to say for today here. We'll see if we can do another stream this week. If not, we'll definitely do one next week. But check me out on Substack there. I'll be releasing a new Substack in the coming days.
That is it for us today, you glorious degens. Smash that subscribe button to join the rebellion, and follow me on X at ReinventIdeal for more unfiltered truth bombs between live streams. And if this was your first time listening, head over to reinventideal.substack.com, because I have a free gift waiting for you there. If you become a free subscriber, you'll get a free copy of my book, Your Parents Were Wrong, Debunking and Replacing Outdated Advice, packed with the wisdom to outsmart the system. It's absolutely free to join, so no excuses. Grab it before the suits catch on. And remember, the bears get blocked right here.